I'm Greg Hunter. Welcome to USAWatchdog.com. With us, economist, the economist that founded ShadowStats.com. His name is John Williams. John Williams, thank you for coming to us from California.
Greg, thank you for having me.
Listen, one of your big themes has been, it's been hard timing this thing because, as we now know, everything is fraudulently propped up, everything from Forex to LIBOR to gold and silver. Thank you, Deutsche Bank, for admitting that you rigged that as well. But what you're looking at is a perfect storm. You've long said that, we have all these assets held outside the country, 16 trillion liquid U.S. dollar assets. And Josh Earnest, when talking about this Saudi Arabia, who's very angry over this Iran deal, that's not a deal, talking about just them selling less than $1 trillion worth of U.S. assets, bonds, that could crash the system. Anyway, basically what I'm saying is that the White House is basically reverberating your idea that when people start selling these liquid assets, the system's going down. Let's talk about that.
Well, when the people start selling the dollar or the dollar-denominated assets, you'll see the value of the dollar plunge. We've had a remarkable rally in the dollar actually since mid 2014. It was up over 30%, I think it was. We're going down by more than that. We're going to be heading to new lows, but we have a circumstance now where because of the waffling of the Fed in the beginning of much broader perceptions that the economy is in serious trouble, which generally would be a negative for the dollar. We have started to see some selling pressure on the dollar. It's been inching lower. It's down year to year now, obviously against where it was last year. But the selling is going to intensify, not only with large central banks beginning to dump their treasury holdings, which have a major impact, but also corporations.
So wait, Saudi Arabia wouldn't be alone. If they started selling, wouldn't everybody look around and go, well, we're selling too? Nobody
wants to be the last one out the door when you have a panic like this. It's not a panic yet, but the potential certainly is there. And as the dollar selling intensifies, you'll see inflation impact coming from factors such as higher oil prices. Now, I mean, there's an oil glut right now, but oil's denominated in U.S. dollars. And the effect is that there's about an 80% correlation with movement in the dollar versus oil, a negative correlation, so that when the dollar weakens, oil prices rise. And where we've had low gasoline prices, and that has helped keep the official CPI number basically flat, some cases negative. That's all of a sudden starting to pick up a little bit because gasoline prices are going higher. Looks like oil has bottomed out, and that was.
It looks like and consequently, it looks like the dollar has topped out here.
Yes,
is what you're saying.
Right, because this is directly tied to the dollar, not so much to basic supply and demand of oil. It's the dollar in which it's denominated.
And that explains, like, wow, we hear all this news about, wow, there's a glut, there's a supply build, there's all these tankers, but yet the price has been rising from 28, 29 up to 40, 44, 45, 43, bouncing around in the 40s now.
Yeah. Well, you're going to see a movement to price oil in something other than the dollar. If you're going to be dumping dollars, and the dollar is going to go down in value, and I'm looking at this, let's say, from the standpoint of Saudi Arabia, which has been threatened. You're dumping the dollars, but at the same time you're receiving your oil revenues in dollars.
So you think that yuan oil fix, the petro yuan, is coming?
Well, that or some basket of currencies. I don't know what it's going to be, but the move once they move away from pricing oil in the dollar, that's going to accelerate the dollar's decline. And other commodities will tend to rise in price, in particular gold and silver, which we've been talking about for some time.
Well, they're trying to crush it. And of course, the Chinese have an answer to that, the Shanghai Gold Exchange, which also sells gold, silver, platinum. I want to talk to you a little bit about your speculation about this big meeting a few weeks ago. Well, meetings. Emergency meetings with the president, vice president, Janet Yellen, Federal Reserve Board presidents, governors, emergency, sequential meetings a couple of weeks ago. Could you be our fly on the wall and speculate as to what Yellen was telling the president and vice president about what was going on? Could you just give your speculation, and we're going to just deem this speculation. So give us your speculation. What Janet Yellen walks in and says, hello, Mr. Vice President. Hello, Mr. President. Well, let's get right to it. What does she tell him?
I don't know what she told him, but I think she's got a pretty good sense of what's really happening to the economy, and I would assume that's what they talked about. The economy's in terrible shape. It's we're seeing an accelerating downturn, although it hasn't been reported yet in the GDP. We're getting very close to that. Come July, you'll have an annual benchmark revision to the GDP. It takes it back several years. You'll see that GDP growth has been a lot weaker than has been reported. You're going to see some negative quarters there, and I think shortly after that you'll have a declaration of our having been in a formal recession. But consider industrial production. Now, that's a series that's published by the Federal Reserve. I think that's what had Janet Yellen very concerned at the time of the last FOMC meeting. And she said, we have to watch the economy. What they released then was a benchmarking of the industrial production, which gets built into the GDP. And what happened with that was that where the industrial production, up to the point of its revision a month ago, it had recovered from the recession. Like the GDP, and was above its pre-recession high. After the revisions were sharply to the downside. Not only do you now see a sharp plunge in industrial production on a quarterly basis, on a year-to-year basis, and we're now down 2 quarters on a year-over-year basis since 1919, when the production series was first started by the Fed. That has never happened outside of a formal recession. We have a formal recession in hand. But so she could see this. But what happened with revisions, and you don't hear people talking about it, but the numbers are there. The industrial production revised lower so that it no longer has recovered from back in 2007. It has never recovered its pre-recession high, and it's turning down again.
So Yellen's telling the president, the economy's not doing well. We're not going to be able to raise rates. But, Mr. President, Mr. Vice President, if we don't raise rates, the dollar's going to tank. And if we don't raise rates and the dollar tanks, we'll have inflation. And if we do raise rates, the economy is going to just already it'll go straight down. It will go under free fall. Do you think that's what Yellen told the president and vice president? We're damned if we do. You've said this about devil choices, that they're all bad choices. Do you think we got down to this choice: raise rates or not raise rates?
I don't think that's the problem. They could raise rates, and it might actually help things a little bit. But they don't know what to do. They don't have a way out of the panic of 2008. In 2008, the banking system was on the brink of collapse. They decided at that point in time to do everything that they had to, create whatever liquidity, make whatever guarantees were needed, bail out whatever entity had to be bailed out in order to prevent the system from collapsing. They did nothing to address the underlying problems that led to the crisis. But all they did was buy some time. They pushed it a couple of years into the future. The rest of the world's done the same thing. Now you have central bankers in Europe going with negative interest rates. They're looking to, instead of buying government bonds, or buying corporate bonds. They have never figured out how to stabilize the system. They don't know what to do. They can't. What they will not do is let the banking system collapse, and that means they're going to keep providing whatever liquidity has to be provided.
So if it comes down to killing the dollar,
it's going to kill the dollar. This excess liquidity eventually will trigger inflation, and it's a problem that they really don't have a way out of. They could have let the system collapse, and you would have had a deflationary Great Depression, such as Bernanke was talking about, was scared about. But for that to happen, the banking system has to fail, and people have to lose their money. A lot of people are talking about a deflation here because of a debt collapse, all sorts of defaults. The collapse of debt, people not paying their debts, does not necessarily create a deflation. What creates the deflation is a contraction of the money supply. Now, the reason that happened back in the 1930s was the banks went out of business and people lost their deposits. There was no FDIC insurance. Your cash just disappeared; it was gone, and the money supply shrank by a third, and the economy shrank by a third. That's what they were afraid was going to happen back in 2008, and they did everything to prevent that from happening. The other end of it, though, is that you're opting there for a long-term inflationary problem, and we already had one that was in place. I've been talking about for years, because the U.S. has been living beyond its means, and what they did to try and counterbalance part of that was to boost the dollar. And how did they boost the dollar? Well, despite all the easings they had put into place had weakened the dollar. Then they started talking about reversing the easings. Oh, we're going to raise rates, and I don't know what the exact timing was, but they were talking about raising rates for at least a year, maybe close to two. And every time they wanted to boost the dollar, you'd have one of these guys. The Fed officials are playing good cop, bad cop. They were simply manipulating the markets with their comments. Oh, we're going to raise rates. Oh, no, the economy's too weak. We're not going to raise rates. And they played it back and forth, back and forth. Then we finally got a rate raise in December of 2015. And at that time, we're going to raise rates in March. Well, that disappeared very quickly.
Well, then we also had the worst start at the stock market in the stock market history in January. It cratered.
They're playing good cop, bad cop again. They don't know how to handle it. They have no way out. What's going to happen is there's going to be a crisis. There's going to be a major failure of in the banking system somewhere in the global community. They'll do whatever they have to do to prop that up. But with that will go any charade that's being put forth as to, yes, we're going to contain this and keep inflation under control. To save the system, they've got to accept the inflation, and in principle, that's what they've already done.
Well, if they start inflating the world's reserve currency, let's just play this out to the end. Don't the Saudi Arabians of the world say, we're not going to price oil in dollars. We're going to sell dollars. I mean, there's a dead end here, is there not? I mean, they can't keep doing this in perpetuity, right? Isn't there a dead end if they keep making this choice, like you're saying, they're going to prop up the banks? They can do it as long as the dollar doesn't blow up. Am I right about that? Explain.
Well, the dollar will blow up, or when I say blow up, it'll collapse. There'll be panic selling of the dollar, and that will intensify the inflation. The problem is that they don't have a way of avoiding. Now, if they could somehow get the economy back on track, and they would have some room to work with things, but the economy's never recovered, and that's being seen now in these revisions. My goodness, at the end of this week we're going to see benchmark revisions to retail sales. So this happens every year. And what happens with these benchmark revisions traditionally, as they get better quality numbers, is that the numbers get revised lower. The reason being that the headline reporting always has upside biases built into it because they don't want to underreport economic growth. Overreporting is okay from a political standpoint, but underreporting is a political embarrassment. So that as they revise the numbers, they get the harder numbers, and they've got retail numbers from, I think, it's a retail census of 2012 that should have been published a couple of years ago, but it somehow got lost in the shuffle with one of the government shutdowns. So you're going to see some downside revisions to the retail sales. Now you have it with the industrial production. You're going to have it with the retail sales. We're very close to turning negative with the first quarter GDP. That is, the numbers are there. I mean, you had a quarterly contraction in industrial production for the first quarter. You had it for real retail sales. You had it for housing starts. The merchandise trade deficit got worse. Those are all basic fundamentals that are negative for the GDP reporting.
That's the headline. This is the headline. Dallas Fed said the GDP was 1/10 of 1%. I imagine your numbers say it's lower than that.
These guys don't like to come out with negative numbers. But what happens here, and we should, if it were being reported straight and people were playing it straight on Wall Street, you'd see a contraction in the number that comes out on Thursday of this week.
And then we'd be in a recession right here and now.
Well, we are. They'd be inclined probably to call it once they get a contracting GDP, because everything else is beginning to show that. But what happens is the Bureau of Economic Analysis tends to follow the consensus, and their first guess, and it is largely a guess, they figure there's some value to the consensus estimates, because they're picking up something they're not. There's no great value to the consensus. But what they do when they find that they're getting a much weaker number than the consensus is, if the consensus is not looking at a contraction, which it's not yet, or at least not openly, they'll signal to the consensus it's a lot weaker. A year ago, we had the same thing happen. First quarter contracted, and but they first reported it up. I think it was 0.2%. Because the consensus wasn't looking for it. So there's a signal to the consensus, hey, the numbers, we're coming out with a GDP that's weaker than you're looking at. You better lower your forecast, and the consensus went negative. Then the second report had a 0.7% contraction. Then come the benchmarking in the middle of last year, that actually pulled it back into positive territory. But that's going to go back into negative territory with this year's benchmarking. And I think we'll see.
Go ahead.
Just let me finish this. That you'll see a pattern like that, and we're coming up now in a couple of days, so they've already set their number. They'll come in with something below what the consensus is looking at, but it'll still be positive, 0.1%, whatever. And then the consensus will turn negative, and they'll take it negative in the next reporting. Certainly, by the benchmarking, we're going to have a number of negative quarters here that have been marginally, marginal growth, and everything else had indicated they were negative. So when that happens, you're going to see a formal recession declaration following not too far down the road. It hasn't happened yet, but it will.
But your numbers, I always tell people these are the real numbers. These are the unfettered, no gimmicks. This is the real numbers. This is how they are with try to massage them and make all kinds of gimmicks. But the real numbers, basically, what you're telling us with all these, with everything's back down to where it was, with the crash and all that. You're telling us that the Fed and the powers that be sold us a grand lie that we have no real recovery. Is that right?
Effectively, yes. That's there was a little bit of a bounce up, but the other numbers show that we never really had a recovery, and but that's not unusual. You have to. The story that the government puts forth does affect people's outlook. You want people to have a positive outlook.
So they lie to them.
So, I mean, by putting out a more positive forecast or reporting, it actually tends to boost the economy a little bit. So they don't want to come out with a negative forecast, but everyone knows it's not recovering.
How quickly could this go out of control? Because I'm going to come back to this meeting. I know you don't know what was said in the meeting, but come on. Emergency meetings with the president and vice president all in the same room, which they shouldn't do, supposedly. And Janet Yellen in there talking to the president and vice president, all these emergency meetings. What do you think they're seeing? Because they're having emergency meetings, unlike anything that you and I, as long as we've talked, we've never had a series of meetings like this. Well, so what do you think they're worried? Are they worried about a dollar sell-off?
I'm sure they are. But the problem, I mean, from the political standpoint, is that the economy is turning down rapidly. They have a new recession. What happened was as the economy plunged into 2007, that's what they show. They then show the economy rebounding with the GDP now up 10% above where it was before the recession. What happened was it plunged. You had maybe a little bit of bouncing, but generally it's been a low level of stagnation. And now what's happening is you're turning down again. And it's that turning down again. The GDP numbers are overstated, but occasionally the economy gets bad enough that the GDP actually gets pulled down in quarterly contraction. That's what's happening now. So that we're seeing a deterioration in the economy. Now that's bad from a political standpoint. It's always a weak economy, generally, over time, has proven to be a big negative for incumbent politicians. You've been able to predict how a White House would go against an incumbent party if the economy or the income were up or down by a certain point. Right now, the circumstances are such that it would tend to favor a loss of the White House by the incumbent party, that being the Democrats. So the economy would tend to favor the Republicans here.
And you think they're starting to panic? Would that be a good way to with all these meetings? Would you classify that? Would you characterize that as they are panicking about something?
Well, for people who are bound up in the political process, this is about as bad as the news gets from an economic standpoint. You do not want to have a deepening recession going into an election, because the electorate will tend to vote their pocketbooks. If you're the incumbent party, now it's usually the incumbent party that can take action to let's say, stimulate the economy. They don't have any options at the moment, and the Fed doesn't have any options. And at the same time, they're faced with still systemic solvency problems globally with the banking system.
Are you saying that they may have to just sit here and watch this thing crash?
I don't think they've got much in the way of other options. And believe it or not, sometimes the healthiest thing that can happen is to just let the system run its course, because it becomes self-corrective. You go in there and you start propping here and propping here. You prop on one side, it starts throwing something else out of kilter. You prop on the other side, it throws something else out of kilter. It's as difficult as it may be. Nobody wants to see a bad economy. But if you let the system take its hit, if you let the unhealthy banks fail, protect the depositors, but let the healthy elements of the system come forward and grow and thrive because they're being run better. Don't prop up the companies that have been so poorly managed that they're near bankruptcy. That just spreads the misery over time.
And you think we'll have? Is this the year we have the hyperinflation? I mean, you had the warning shot across the bow. The Saudis, there's no way to unwind this Iran deal. It's over. It's the non-signature deal, which means it's the no-deal deal. Nobody signed anything. The Saudis are angry over it. And, could there be a run on the dollar? Could there, and is there already a covert or overt selling of the dollar now? Because that seems to be your linchpin. When the dollar goes, it's over. Is that right?
Well, yes. But I'm talking a massive decline here. We haven't had a massive decline yet. We've been seeing some net selling pressure. The dollar continues to weaken, but it's not been an unstable decline. We've seen the central banks, particularly the Federal Reserve here, would step in as you start to see heavy dollar selling to try and slow the pace, to make it not appear like a panic. If you start to see a panic sell-off, that's a real bad sign. It means they're losing control of the system.
And you think that's coming?
I think that's coming. And the initial effect on the system for people living in the United States is that as the dollar crashes, you'll see inflation beginning to surge, particularly from oil, gasoline prices, and those effects will again begin to spread in the system. It changes the way people look at things and starts the process towards what eventually will be a hyperinflation, because they don't have a way out of the circumstance. They backed themselves into the corner. They've been keeping things reasonably stable, but they can't move off. They can't move off the ground. They can't get things going, and they're afraid to go back because of the downside.
They can't move off, but everybody else can move off, and they can sell these $16 trillion. That's what they have no control over.
And that's what is the big at the moment. Yes,
they're scared of everybody taking this $16 trillion held outside the system and sell.
Mm-hmm. Yeah, I would be.
John Williams, shadowstats.com. Talk a little bit about your service, because I know I get a journalist subscription, very detailed, super detailed. I know that, and I know your client list is secret, so I'm not going to ask you about that, but I know hedge funds and Fortune 500 companies and banks, and there's all kinds of really high-powered people around the world like to use your real numbers. Tell us what you get for how much your subscription, and what do you get for it?
I have a lot of individuals who are subscribers as well. I put out a weekly newsletter. It's at least weekly, depending upon how many major economic series come out in a week. There could be three commentaries in a week. It's available on the internet. It's delivered electronically.
Shadowstats.com.
Shadowstats.com. So you get an analysis of the current numbers, economic activity, with a lot of the huffing and puffing and fluffing taken out of the numbers. I try and give it as accurately as I can estimate.
I'll tell you, you're just so people know, this is detailed stuff, folks. This is in the this is not some cursory stuff. It's long, drawn out, well thought out analysis, real time unfolding. So go ahead. I'm sorry.
I do try to give people a summary outlook as well, for those who are not that interested in the detail. But I also have a lot posted on the website. After 6 months, the older newsletters are available to anyone. The hyperinflation report, which gives you the basic story of what's happening. We have the headlines from the current reports. We have alternate measures on inflation, the GDP and such, which are available on the website to people who just visit the website. But I've also tried to price it so it's not prohibitively expensive. I've got to make a living. And
how much is it a year? Or there are different you can put year, or quarterly, or half year, stuff like that.
An annual subscription is $175. We also have a 6-month version for $89. Same newsletter, just a 6-month subscription instead of a full year. But we always like to pick up new subscribers, and we always appreciate having people visit our site and leave comments and raise questions.
John Williams, I will put a link to your sign-up page and also to your home page on both sides of the interview. I'll also, so all you YouTube folks, click on the link that takes you to the USA Watchdog page, and it'll take you to the his buying page or his subscription page, and also shadowstats.com. You can just Google it too, shadowstats.com. Very easy to find. John Williams, economist John Williams at shadowstats.com. Thank you very much for joining us today on USAWatchdog.com.
Thank you for having me, Greg.